I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout the show. The stock market got smacked early last week on concerns about a pending default by China's huge real estate developer Evergrande, and then spent most of the rest of the week rebounding as those fears lifted. Mixed messages came out of China, first looking like a default was definitely coming, and then saying that on Thursday they would be making the interest rate payments. Then the government said they may be taking over the company and managing, dissolving the company and selling off parts. Then the warning came to prepare for default, and it came to fruition on Friday morning. It was reported that while they did make their interest rate payments to the locals, they failed to make the payments to dollar-denominated debt. That is a default, and there may be more coming and more repercussions coming down the road from that and other companies. Investors have just got used to this and used this decline as another opportunity, as we've seen since the pandemic low since March 20, to jump in and take advantage of lower prices. Helping with that midweek surge was the FOMC, as they clearly want to walk incredibly slowly to the door of reducing this 12-year-old emergency stance that they've been in. And their movement towards it is barely perceptible to the human ear. Maybe they might start to taper, as they say, in November or December, and winding down QE into mid-22, but they warned they would go slower if they needed to do so. They may raise interest rates in 22, which a couple of the Fed governors would like to do, but most of them say 2023 before there's an interest rate increase and taking interest rates up into 2024. They seem incredibly confused, no idea on growth, and completely ignoring the inflation situation, which actually may be improving. Bonds took the coming policy change to heart, and the bond market sold off pretty hard. And often we see bond markets lead the stock market. And that happened, well, probably not in a lot of your lifetimes, but when I first became a trader, that's what we looked at. When the bond market ticked down, so did the stock market. So maybe we're going to get back into that. And I assure you, as we look at all of these machinations going on with the FOMC, the attendees of the secret meeting in November of 1913 on Jekyll Island, they got to be rolling in their graves. At the time, they gave into the formation of a central bank, despite the warnings of the Jeffersonians since the 1700s, and the result of that they warned would be excessive use of power. Well, we see that is true worldwide, as these central banks all over manipulate to hold markets up so that we all feel wealthier and spend more money and take on more debt, because we're in a massive debt bubble right now, and they are creating it, very much so. So as a result of this feckless Fed, we're in the everything bubble. Lots of markets popped already, as we've seen the SPAC price come down very sharply, the average price of SPACs. Cryptocurrencies, of course, had a big decline. Bitcoin fell 57%. And it's very weak today on some China news that they're making all cryptocurrency transactions illegal. And so there was a big crack there, and I think there's much more to come. And we've seen big breaks off of panic highs in iron ore and grains and lumber. So this everything bubble, and I'm going to say more about that, has been in a rotational bursting going on. With the U.S. stock market holding up spectacularly, and we've shown many charts in the past about the excesses that have been going on right now, especially in relation to valuations compared to the Buffett indicator, which is now over 200% of GDP, which history has never shown anything like that at all. And right now I want to show you another chart as we're going to look at this chart right over here. Thanks to the Felder report for putting this out. I picked this up off of Zero Hedge. This is the S&P 500 index, and the number of components trading at 10 times sales, which is just an unbelievably excessive amount. If you look over here at the dot-com bubble, there were about 48 of them trading out of the 500 at 10 times sales. That brought a big collapse at that really excessiveness that was going on. The housing bubble extreme wasn't quite as big. You can see that with maybe only about 23 trading at 10 times sales. But now in this everything bubble extreme, as the Felder report says, we now have about 67 of these components trading at 10 times sales. That is absolutely incredible. This is craziness, the amount of money that people are willing to pay for this just incredibly overvalued market that we're in right now. Just absolutely incredible. Thank you, Fed, for this, for making everybody feel really rich, and for getting everybody to come in and play this game, this happy game that they're having right now of hot potato, in which they're hoping that the greater fool steps up and pays one of these ridiculous prices. Well, trouble is looming, and we're going to show you that in the short-term view coming up. It's about the when and how. We'll know when there is danger in this market, and just as we had in all of these other markets, in these bubbly markets that have now had resets and are trying to rebound a little bit right now, the great reset in the stock market is coming down the road. There's a dangerous decline. I don't know if it's coming in weeks or months, but it is coming, and we'll get a good sense about how that comes from the charts and the way that we look at them. And I'll speak more about that going forward. Stocks for the week, they're having quite a rebound here in midweek. In fact, it's the biggest 3-day bounce I think we've seen in all of these cycles back since May. Friday weakness came, and the market, of course, rebounded again. Nike was helping out on the downside. Nike's down over 5% as they gave some warnings on their earnings about supply chain problems and margin problems, and that's what happens when you get into markets that have this massive amount of male investment that's going on. Bond market, the 30 are up about down about 1.5%, in this mixed market that we're having in the stock market this week, and it hasn't changed very much. There were some times when the bond market was moving down sharply, and the market absolutely ignored it. And there were some times when it seems like they were moving together. TNX, that's the 10-year, moves up 8 basis points. It's a pretty sharp gain. And the short end of the curve is doing the worst of all of them. But overall, we're seeing breakdowns. We see the likelihood of lower prices in bonds, and we've been warning about that. Lower prices, higher yields coming. Gold market down about $9 in the week. It's still very weak. Silver down small, and I've got a lot more to say about that coming up in just a few minutes. The dollar up just a little bit on the week. And the oil market, crude oil up about 170, very strong. We were expecting higher prices coming. There are tight energy markets in Europe and in Russia, and we saw natural gas flying on the upside. Pullback. We think natural gas is probably going to be moving to the upside again. Coming up in this show, we have our preview of the stock sectors, in which Ari is going to bring you a real good look of cycle analysis in his stock sector review. And I'm going to bring you a big picture on silver, and I'm also going to bring you a review on the SPY, Spiders, 1 to 3 month view. Here again is that unbelievable overbought condition. Don't forget about this as you're thinking about investing or potentially removing risk. We are so overpriced in the stock market. And if you are new to our shows, new to what we do here, please go to our website and become a free member. If you want to get a little taste of what we do, I'm going to give you a little preview of what our special is for level ones coming up. If you're on YouTube, subscribe to our channel, give us a thumbs up for sure, click the notification bell, and they'll let you know when we put up another video. On Twitter, follow us at askSlim. And for membership info and questions on our huge offerings of education and analysis, write Matt at askSlim.com. All right, every other week, Arvi does a video on stock sectors. This week, he's going to review the ETFs, and he's going to show you a preview here on this show of XLI and XLV. And next week, we'll be bringing back the international markets. So here is that special.
Look at the XLI, which is the industrials ETF, and we see a really very similar pattern. You can see a swamp cycle here, the bull flag that turned up nicely, got a really nice rally once more. And what you'd normally look for is, given the fact that this is a higher low relative to the prior low and a higher high relative to the prior high, that's called a positive cycle. And when you have a positive cycle, you'd be looking for, at the very least, a move to these old swing highs right here over 106.81. But note what happened. We had a failure versus this intermediate 78.6 fib, and now we have had a breakdown below that key weekly low, which says that this dominant cycle here has turned down, and we would look for rallies to fail as long as we stay below this key high here at 105.73. So that's the overall picture in the XLI, a bearish look. Note that there is a mid-cycle low due in mid-November here as well. So the overall shape for this would be like a move down here into this mid-cycle low, likely to this intermediate support zone starting around 94, then a rally off of that mid-cycle low, and then another wave on the downside. And if I highlight this cycle here, we have a key dominant low due right around March or so of next year. So a very risky pattern setting up in the XLI. So this is the XLV, and we have been positive on this sector. We last looked at this right around this time period right here. We saw this really bullish cycle forming here, just looking for a minor pullback, which is what we got, and then we turned back up on the upside in this new rising phase. We were looking for a rally at the time only up to this 133.69 level. We have moved through that. We are now looking at this intermediate 61.8 at 136.42, and you can see a decent failure versus that level, and we have also had a failure in our weekly momentum where it has turned from bullish to bearish. Now note that we have a mid-cycle low due really right around now. So what we're seeing this as is a bull flag. We are testing the intermediate support zone as well from 131 to around 127. So we would look for this to turn up one more time and get into the rising phase on the minor cycle. And based on this overall structure, we would look for a retest of this intermediate 61.8 around 136.34, and then we would be watching for a failure and then a movement back down as this dominant cycle would take hold and then start to push on the downside. Our next key low is due out in January or so of next year. So that's the overall picture in the XLV, is a overall positive pattern, really a bull flag likely forming, and then looking for another test back to the upside.
Thank you, Arvi. That was absolutely great work. Remember, you could see that full video by becoming a level 2, 3, or 4 member at askSlim.com. This is my big picture analysis on silver. We're going to look at weekly and monthly charts and at our momentum tracker to get a sense of the condition of the silver and precious metal stocks as a whole. We have been discussing with our members that the precious metals were in a weak condition, that it was likely that rallies would be failing, and we've seen some breakdowns going on. We want to show you that. So I'm going to show you the weekly chart that I share with our members, and then we'll take a look at that monthly. And I'm going to compare the dollar index, which I think is important in this analysis, and I think you're going to find it pretty fascinating. Here is the silver market on the weekly chart. For those of you that are new, these are cycle brackets that are on the bottom. This is how we look at the money flow conditions of the market. This is called a harmonic family right in here, made up of the dominant and, in this case, two minor half cycles, which track the gold, which is that dashed line, very closely, as you can see. So gold and silver, of course, correlated very closely. So what we're looking at in here, first we'll take a look at this big cycle right there where silver had this massive spike coming up from like $12 to close to $30, and then went into a correction and came down and touched the support right over here and then move up again. When you get a positive cycle like this one, configured very well with the low way above the previous low, the probabilities are better than 70% of testing or taking out that last high, which you can see it did but could not hold. Then this next cycle was sideways, but I want you to note where the peak came, on the left side of this dominant cycle. That's important. When you make a peak on the left side and you come down, you often come down and give up all or most of this previous gain, which you did. When you do that, you set up the next cycle to be weak. And the majority of the time that is the case. So what we're warning about right over here is that this next rally right there already failed, and that it hit that resistance confluence area, which comes off the multiple peaks right over here, and then came down and actually broke that low, and that dashed line is called a VTL, a valid trend line. You can learn about valid trend lines in our cycle analysis workshop. So this breakdown here below that low, this poorly configured look right over here, says to us there is trouble here in the silver market. It would need to get above that level, above close to about 25, to improve this enough to say, well, the mostly negative scenario would not be in place. In fact, it would turn more positive. But right now we're looking at this, and this dominant cycle right there points to April. It's plus or minus a few weeks, so it might come out to May, even June, as far as when that next low is. So what we're looking at are these lower peaks and lower lows potentially setting up continued downside. I'll show you on the monthly chart where these supports are right over here and how it's likely to come down. So I want you to note that this comes down into sometime around April. And then the next cycle after that, were it to continue on the downside, would go out into maybe sometime between September and October. So that's important to this analysis. This is a negative analysis. You can see in here where the momentum turned up on the reversal scout, our momentum indicator that we're using. You got a good rally at the bottom of this cycle. Same thing happened in the minor cycle, but here where it turned up, momentum was really powerful on the downside and remains negative. This is a very negative occurrence when we look at this, and sets up an intermediate analysis, well, that's just plainly not good. Here we take a look at the monthly pattern, and the same thing, we're looking at monthly cycles, and we'll look here and you can see the beautiful rhythmic action here over these months and the important lows. Now these yellow areas are areas of potential large declines. That's when there's a nesting of this gold and silver all coming in right here and right in here and right in here, and those bring large declines. You could see that we still have months to go on the downside when you look at this, and that really sets up for some problems. So this low points out over here to an ideal low sometime in August through October, and that really looks like, we'll say, July through October, and that is looking like any rallies in here are likely to fail, in line with what we showed on the weekly pattern. This support over here is at about 2075. The support here is at about 1875. So this is your weekly support area and buy zone. I've had some people writing to me, you move this out on the projection. Well, that's because this is where it aligns, and we project it out based on the weekly patterns that are suggestive that, well, for the next somewhere around 8 to 11 months, the silver market's going to be in problems. So this takes you out to, let's just say, August, September, October for a decline right out over here, and that means that all the rally periods that we're likely to get in here were likely to fail and then be moving to the downside. You see these rallies that failed right over here and it continued to move to the downside. Well, that is what we expect in silver. So for those that are buyers that want to accumulate silver, well, I would say do it slowly, as I am, and expect that you're going to pay lower prices, and that might be a good thing if you're a very long-term holder and are not too bothered by this, what is a very potentially risky period coming up. If you're a trader, then of course the bias would be to the short side. Let's just look at the inverse to silver, which is essentially the dollar market. Remember, if dollar is stronger, it takes fewer dollars to buy silver and gold, so essentially the silver and gold price is lower. Here is the dollar lining up, and you can see its corrective periods by these yellow zones. And this is the corrective period here, and you got a big decline, and we talked about that projected big decline. We expected that, just as we did here and here and here. And note when momentum turns up and up and up, all of those declare these cycle bottoms, and we had the same thing happen right over here. So what I showed you in silver was that the likelihood would be for a decline out into 22, out into sometime in the late summer or fall. The rally phase in the dollar points to the same place. So there's inverse correlation that is setting up in here, and we would expect that the dollar will be strong, and we're projecting up to around 96. We showed this in the big picture analysis we recently did in gold also, which makes sense that the correlations would be the same. I want you to note here for our members, this note, we expect dollar positive period to last at least through mid-22, and of course that would be the large period where silver and gold could be moving to the downside. So you can see these beautiful monthly patterns. Remember, our level 4 members and level 4 plus members get these live on their Thinkorswim TDA Ameritrade platform. So if you want to get all of our charts live on your platform, do become an askSlim level 4 or 4 plus member, and then open up a TD Ameritrade account. Just go to our website and go on the top carousel on the front page, look for the TDA page, and then click on that. You can open up a TD Ameritrade account and get our charts right on there. So that is a look at dollar right over there, and that is inversely correlated to the silver market, which we see moving to the downside well into next year right over there, and this weekly negatively configured pattern that you see on that cycle in silver. That is a pretty negative looking chart right there, and overall quite a negative looking scenario. So that's looking at the chart analysis. I want to take just a couple of moments to show you our momentum tracker and look at this group right over here. So this is the askSlim momentum tracker. This is an app that we developed, which is just phenomenal. It has our proprietary analysis in there, automated through our algorithms, that shows you the conditions of the market. So right now, if you look at the long-term conditions right over here, it takes all of these stocks, all of these symbols that are in this category, and then shows you 84% of them are in long-term negative condition. You can see in here that we have all of these canned groups in there, and you'll be able to look at it in all of the groups that you want to if you do use the momentum tracker. I'm going to put on the directional bias ratio, and it shows you that 79% of the symbols in this group are negative, 21% neutral. There are no neutral to very neutral, there are no bullish to very bullish symbols at all in here in all of these symbols. I'm going to look at the directional bias, and you can see in here Newmont, PAAS, AUY, Yamana, all of those extremely negative. Long-term, intermediate, short-term, all of those extremely negative. And you can see that. The question is, okay, when did they become negative? Let's just look at, well, Pan American Silver here, and I'll just show you how this all shows up on the chart that we put in here. By the way, this is built off of a TradingView chart, and we're adopting more and more things off of TradingView. I want you to see in here that, there were periods it was positive way back over here early part of the year, and it was able to hold up, but then it started to turn neutral, and then you started to get these negative readings, and it's continued to be negative in here in PAAS. Very negative to somewhat negative is the kind of readings that you're getting in there, And that is a look at the kind of things that you can see here in the momentum tracker. This has all been really negative. When you look at that, there are a couple stocks in here that are neutral to slightly bullish. Wheaton Precious Metals has better chart patterns on there. You could see long-term is positive, neutral on the intermediate, and short-term is negative. But since the long-term is a heavier weighting, and it has a bigger influence, then it's neutral to slightly bullish, as you can see here. The same thing for Endeavor Silver. The condition-wise, if you're interested in silver, then you might be interested in these two as maybe less dangerous under these conditions. And again, of course, you can see all of these very bearish ones right in here as I move down and give you a peek at a lot of these stocks that are right in here. That are really negative. Here we're getting from very bearish to slightly bearish in that category there, and then one neutral, and then the bullish ones, neutral to slightly bullish on the bottom. So this gives you a very good picture of this momentum tracker. Stick around because I'm going to show you how to get the momentum tracker in just a moment. This, of course, really, I think, excellent information. So that's a look at the big picture in silver, weekly, monthly, all of them pointing to negative conditions. The stocks, individual stocks, very negative conditions also, and that is the big picture. So I hope you found that. Don't go away because here is a special. This is the askSlim level 1 special, so you can get that momentum tracker I just showed. We have over 1,000 symbols in there, plus those canned groups. You can scan, sort, this is really the best way you'll ever see true momentum conditions. You'll get our weekly stock index report packed with technical analysis, weekly ETF review, our new trader workbench where you can just organize and save all of your analysis and track what your analysis. You can get this archive to this show and review everything that we've done. You'll be included in our live events, and also you'll be able to watch the replays and our special member videos. Normally all of that would be an incredible $19.95 a month. I mean, for that momentum tracker, imagine how much more you would pay for that elsewhere. We're going to let you see that all for $10 a month. $30 for 3 months is our special. That's a half price off to become a level 1 member. Go to our website, become a level 1 member. You have questions on that, everything that we offer, please write Matt at askSlim.com. Level 1 special, $30, 3 months. How do you beat that? Please do sign up right now if you're not already an askSlim member. All right, we're going to look at the stock market now at the SPY, our 1 to 3 week view. We have been looking for a correction that would come into the end of last week, beginning of this week, and that did come and came very much on time. We have had some lack of clarity in the intermediate patterns, and I'm going to show you right now what will give us clarity in that also. In the meantime, the short-term patterns have been spectacularly good, and I hope you have benefited from using those patterns and all of the momentum indicators that we do supply. Let's take a look here, and we'll look at the SPY. And a little different than I've shown you when I put up the SPX. And here what I want you to see are the repeating cyclical patterns. On the bottom right over here, cycle brackets. Those are just simply a drawing tool that show us the average cycle. So the average cycle period on here is 20 days. And then these vertical lines are the actual. So this is the ideal, this is the actual, and you can see they're very close. And they've been averaging about 20 days. This one was 23 days. There were some 18s in here, and this one was 21 days. Now, this yellow area here was in line with where we thought there might be an intermediate decline. We talked about the potential for a decline of between 4.2% and 6.7%, which was upgraded from our original expectation of 11%. You'll note this was a 5.7% from peak to trough on the downside right over here, but we're still not 100% sure whether or not an intermediate bottom was earlier, because this would be at a 28th or 29th week, which is exceptionally long, or this is actually it. Now we want to note that each of these cycles in here has had seen at the bottoms in here, and when we got the upward turns from where the slim ribbon turned green, and this is the slim ribbon PO giving you the upside signals. Each of those gave you good velocity on the upside off of those lows. We have good velocity right now with the S&Ps moving up some 150 points off of that extreme low on Monday. But something is different. Each of these made new highs when it was doing it very quickly because of the depth of this decline and the negative configuration and the breakdown under that support. Then that only gets you up into the resistance sell zone right over here. So it is different. Things have changed. In addition to that, each of these, and you can see how green this is, and these upward giving you upward warnings right over here, each of those were telling you of positive conditions. And here you're in a negative condition. That is significant. Moving up to the slim ribbon when this is negative is a area where you would expect it to sell and move down very considerably. So here are the important numbers that I want to share with you. If the market is able to keep its legs and keep moving up, maybe have little pullback into support and then move up again and take out 449 on the S&P, that will indicate a intermediate cycle low has formed and things are likely to be stronger, and even the market going out to new highs. If it fools around here for a while, comes down and hits the support zone but does not take out this low at 428.86, it will be a base or bullishly configured cycle, and that would be positive. If it breaks underneath this 78.6 right over here, which is at about 432, that will be a warning that the next rally is likely not to get above these levels, and that somewhere out over here we're going to resume this decline. If it breaks this low at 428.86, the odds are very high of continued very sharp selling. If it breaks this low here at 432, it warns that you're likely not to get above the sell zone. If it breaks out above 449, it warns that an important low is made in here, and though it might base and not go straight up to new highs, at some point it's likely to test that high. So it's, in our opinion, the information off of the daily chart is very important and very clear and will give us clarity on the longer pattern. So you can see our, if you remember, you can see the complex cycle structures on the SPX chart, which has been updated for our members today. So level 4 members, level 4 plus, and the level 3 members will see it in static version when it's posted up in the ranking system. So you will see all of that. That is our 1 to 3 week picture that we see in here. I think it's very clear. The messages will be very clear from the market. And right now, the evidence, some of the evidence is suggestive that it will fail from the sell zone. The question is, will it break key supports or will it set up a more positive pattern? That is the short-term view for the stock market today. I hope you find that unbelievably informative. Don't forget to go to askSlim.com, become a free member, or take advantage of our special level 1 membership that I showed earlier in the show. If you're on YouTube, give us that thumbs up because you love what we present to you right now. Subscribe to our channel, click that bell for notifications. Watch our other videos that are in the playlists in here. Follow us on Twitter at askSlim. And for membership information and questions on our huge offerings of education and analysis, write to Matt at askSlim.com. For those of you that are members and have any questions about your memberships, please write team at askSlim.com. That is it for today. I hope you found this to be unbelievably informative, and there's been just great information for you. I want you to be incredibly careful because it is so crazy out there. And I'm always wishing you great trading.